Initial key takeaways. Biden's late withdrawal is unprecedented, but there are 5 loose historical comparisons. The incumbent not seeking re-election has not prevented the second half election year rally. Earnings revisions are a bigger concern than politics over the near term. A year of firsts. As market historians, we get excited about rare market events. They provide an opportunity to put market action into perspective and draw historical parallels. Keeping our historian hats on, this presidential election cycle has been filled with firsts. This year was on track to be the first since 1892 that both major party candidates had been president. Trump is the first former president convicted of felonies. He is also the first candidate shot on the campaign trail since 1972. First amongst firsts. And for the biggest bombshell, Biden withdrew from the race on July 20th. The latest from a presumptive nominee in modern presidential history. We see one true historical comparison, and it is far from perfect. In 1968, incumbent Lyndon Johnson withdrew from the race after a poor performance in the New Hampshire primary. He exited on March 31st, 4 months earlier than Biden. Voters and investors had plenty of time to adjust. The stock market rallied, with the Dow adding about 5.7% over the next 2 weeks. The benchmark never fell below its March lows through year-end, enjoying a 19.4% rally into early December. Loosening the criteria, there are 5 cases since 1900 when the incumbent chose not to seek re-election. All but one occurred before the 22nd Amendment established presidential term limits. The lack of an incumbent did not derail the typical second half election year rally as shown here. Another conclusion is that the market is driven by more than politics. Earnings will likely have a bigger impact on the market in the second half. I am not a big believer in using historical analog charts. I think every environment is different, and so expecting the current market to play out exactly like a past one rarely works out the way that some believe it will. Still, it doesn't hurt to at least keep them in mind. In the case of a sitting president dropping out of a re-election race, the only modern parallel we have is the 1968 election. It's not an apples to apples comparison, of course, but in 1968, the Dow Jones Industrial Average traded sideways over the summer before bottoming out in early August. It then went on a tear until the start of December, when it finally pulled back in heavier fashion, as can be seen here. Previous 2 elections for immediate perspective. Very similarly, the 2016 election year saw the S&P 500 hang in there until around the start of September before a softer patch into Election Day. Then, once again, we got a rally into the end of the year. In both 2016 and 2020, the market slowed in the 2 months leading up to the election and then took back off. As a result, I expect many people will be watching for a similar post-election rally once again. To me, that suggests we should perhaps be on alert for something else to happen if everyone will be leaning the same way. More recently, I guess it's worth at least looking back at the most recent presidential election season as well for perspective. This chart shows the S&P 500 in 2020, when Joe Biden defeated Donald Trump in November. The vertical line highlighted in yellow shows where we are now. And in this picture, the market rallied into early September before going sideways into the actual election. Afterward, we saw a rally into year-end. Of course, this was also the COVID year, when people were being sent money to spend by the government, and everyone was sitting at home shopping and day trading. Not a perfect comparison, but there it is, a quick recap of history. The most comparable year, 1968, was described earlier and was shown in the chart earlier. So let's discuss the 4 other cases. 1908 was the first one. In his 1904 acceptance speech, Theodore Roosevelt announced that he would not run in 1908. Teddy assumed the presidency when McKinley was assassinated in 1901, so he was adhering to Washington's precedent of not running for a 3rd term. Although he was floated in 1908, TR threw his support behind his vice president, Taft. The Dow soared 46.6% in 1908 as Taft was viewed as a continuation of TR's policies. 1920 was next. Even though he had been weakened by a stroke in October 1919, Woodrow Wilson let it be known he would be interested in a third term. He was never seriously considered at the Democratic convention. The Dow tumbled 32.9% as the economy suffered from a severe recession due to hyperinflation after World War I and the Spanish flu. Next was 1928. Calvin Coolidge assumed the presidency after Harding's death in 1923, so another term would have been consistent with precedent. When asked, Silent Cal only said, "I do not choose to run." Some wondered if he hoped for a groundswell of support, but Republicans chose Hoover. The Dow jumped 48.2% as investors viewed Hoover as a continuation of Republican laissez-faire policies. Then it was 1952. The 22nd Amendment was ratified in 1951, but Truman was grandfathered. Due to low approval ratings and a poor showing in the New Hampshire primary, Truman announced on March 29th that he would not seek re-election. The Dow bottomed on May 1st and rallied 13.9% through year-end. In the final analysis, it's the earnings, stupid. Democratic strategist James Carville coined the phrase, "It's the economy, stupid," to frame the 1992 election. To paraphrase Mr. Carville for the stock market in 2024, it's the earnings, stupid. The recovery from the mild earnings recession in 2022 has been one of the keys to the bull market. Earlier this year, what I was focusing on for this quarter's earnings season. While too early to draw conclusions, a few things that I will cover in future reports in greater detail could be directly linked to the recent pullback. Two of the keys were the beat rate and Mag 7's high expectations. Both took a hit with Tesla and Alphabet's earnings. The S&P 500's beat rate is a solid 80.2%. However, technology sectors is at 60.0%, the lowest since Q4 2008. Only 7.5% of tech companies have reported, so it is far too early to draw conclusions. But Q2 earnings season is not off to a great start for the biggest sector. Action out of Alphabet this week started this. Another key was second half estimates. Q3 and Q4 year-over-year growth rates were close to 20% coming into earnings season. The question was not whether they would be revised down, but when and by how much. Since the end of June, both have dipped slightly, but they are still calling for hockey stick-like growth in the second half. Even if Q3 and Q4 earnings growth settle in the low double digits, which would reflect quarter-over-quarter acceleration, the process of revising growth rates down could be messy. As I've said, history provides precedent, but never the same. Things tend to rhyme. In the end, it should be most dependent on earnings and the fuel, provided or not, by lower interest rates and cheaper financing after the sharp interest rates the Fed imposed earlier. We will certainly keep you apprised, but for now, I felt perspective would be important and quite interesting to all those that choose to follow closely. As always, should you wish to discuss your individual situation or ask any personal questions, we are always here to answer them in a timely fashion.